Good morning. It's Jeffrey Christian of CPM Group. It's 11:55 in the morning here in New York on Tuesday, the 21st of October. I want to talk about the debasement trade meme and show you some data about what's really happening with the US dollar. I've been hearing about the debasement trade. I've had reporters talk to me about the debasement trade, and it's kind of a joke. But let's talk about the markets first. Gold prices are off $220 this morning. They're $4,143. We are looking at a price that really, was $3,400 just a month and a half ago. It has risen very sharply. It's tested 4,400 a couple times, and it's backed off. CPM Group's expectation is that, yes, there is a potential for the price to come off another 150 or even more in the near term. The price has risen very sharply over the last week into this week. And, the idea that the price could go to 4,000 or 3,800 on a short-term basis cannot be ruled out. Longer term, we still expect prices to rise. The political and economic problems and issues that have been driving investors to buy historically large amounts of gold and silver are still in place, if not getting worse. And in this kind of environment, we expect investors to continue to buy. We expect them to buy on dips when the price rises from $4,000 to $4,400, 10% in 5 days. One would expect people to hold back and see if the price falls back to $4,000 in the next 5 days before buying. So our view is still that prices are likely to rise higher because the political and economic environment's not getting better. It's getting worse. Every week that the United States government is shut down, it's estimated that we lose 0.2% of global annual national gross domestic product, economic growth. So being in the third week now, we've already lost about 0.5%. We've been teetering on the brink of a recession and recessionary pressures before the shutdown of government on October 1st. And this doesn't really help the economy. Silver prices also have been falling. They're off $3.51 this morning, down to about $47.91. Again, still very high prices, almost record high prices. We did see new records last week. The price got up to almost $54 an ounce. The idea that it could come off further to $46 or even $42 or $40 is possible. The upward trend would still remain in place. And again, the economic factors that have been driving investors into silver continue. There are some supply issues in India and secondary supply issues in London. There's a lot of misinformation and misrepresentation going on. Refineries are melting down the enormous stash of silver investment products that have been sold back by investors with the higher prices. Refineries are backed up, refining that and casting it into 1,000-ounce bars that are good deliverable in New York or London or Mumbai or other places around the world. So there is silver out there. There are some supply allocation issues in India and in London. This probably will continue for a while, but the overall longer upward trend that we've seen over the last 5 years remains in place. And, quite frankly, from a technical perspective, the price of silver could fall below $34 and still be in that upward bull market that started in 2019. Platinum prices have come off sharply too. $116 so far this morning, down to about $1,536. That's still very high. That's still in that 14 to 16 the $100 range. That is what we see as the sweet spot where investors are reevaluating their long-term expectations for platinum. So it's still up there. It's still well overvalued compared to the prices that we've seen since 2015 until June of this year. But you are seeing some potential for further profit taking from short-term longs. And palladium prices off $100 a few minutes ago, 20 minutes ago. But again, they still are high relative to where they've been since late 2023. We don't see them spiking up to 2000 or higher until the range that we saw in 2020, 2022. But we do expect the prices to subside ultimately, going back down toward 1200 in the longer run, 1200, 1300. Turning to the debasement trade, the dollar is hardly collapsing. This is the trade-weighted dollar. You can see it got to a very high level by historic standards, recent historic standards, in January. It has fallen 6.6% since that time, and it's been moving sideways for the last several weeks, couple months. In terms of a longer-term view, it's up 10% from where it was in its 2021 low, and it's up 42% from where it was in 2011 at the height of we had gone through the global financial crisis and the Great Recession. We were in the midst of the downgrading of the U.S. Treasury because the government couldn't get its act together. Deja vu. And in the midst of the European sovereign debt crisis that was going on at that time. It's up 42%. Off 6.6%, not necessarily collapsing. If you look at central bank figures, this is the total foreign exchange reserves and the share of those total foreign exchange reserves in the U.S. dollar. And you can see, going back to 1995, there was about $1 trillion in central bank foreign exchange reserves. By 2010, that had risen to $5 trillion. By 2022, it was $11 trillion. And it's been rising ever since that time. 3% in 2023, 0.2%, relatively small in 2024. Wasn't a great year for central banks. And actually, central banks were spending a lot of their money helping their economy, propping up their economies and helping them stay out of recession. So you saw drawdowns at a number of central banks for economic factors in 2024. Sprung back somewhat in the first half of this year. By the end of June, it was up about 5% at $12 trillion. Of those foreign exchange reserves, usually the U.S. dollar has maintained a large share of the market. The bottom line, the dollar as a percent of totals, you can see it was 59% in 1995. It was actually much lower in 1985, but that's off the chart here. 62% in 2010 during the sovereign debt crisis in Europe. 58% in 2022, 58% in 2023, 57.8% in 2024, down to 56% this year. So not exactly being dumped by central banks. The dollar, you did see about a 0.9% reduction in 2024, and it's up about 2% as opposed to 4.8% for all reserves. I think I skipped over a chart, though. Let me just sort of see here. I guess I didn't. I guess I put that chart. Central banks are using their dollars. The decline in U.S. dollar holdings in 2024 and the slower increase that we've seen in the first half of 2025 doesn't represent central banks dumping the dollar. It represents central banks using their monetary reserves to shore up their economies, notably China, but other countries as well. The People's Bank of China has reduced its total reserves about $1 trillion. Now, of those total reserves, more than 60% are in US dollars, and the dollar has been strong. Most of their monetary reserves are in liquid US dollars, not just in China, but in other central banks, as opposed to less liquid other currencies. And the dollar is high against most currencies. I just showed you it on a trade-weighted basis. It's off from the January, but it's still at very high levels from a perspective of the last quarter of a century. The logical action for a central bank is to use your appreciated dollars, which are more liquid and of higher value, as opposed to the smaller tranches you have in other currencies that are weaker relative to the dollar and less liquid. So the dollar holdings have been flat to slower, not because of some anti-dollar posture on the part of central banks. The dollar holdings are flat to slower, increasing, reflecting their use and their usefulness and the central bank's perception of the usefulness of having US dollar reserves. If you go back 10 years or 20 years ago and talk to central banks, as we did at that time, there was this view of moving away from the dollar and decreasing the percentage of your foreign exchange reserves that were in dollars. The dollar was very strong for periods of time back then. It's even stronger now. In the most recent 15 years or so, you've seen more and more central bank economists talking about, well, maybe the dollar doesn't lose its reserve asset status. Maybe the dollar is the preferred foreign exchange holding for us. It's not dollar debasement. It's currency pragmatism. Again, if you take a look at it, you've seen a small decrease in 2024 in dollar holdings and a less dynamic increase in the first half of this year. But the dollar still represents 56% of the foreign exchange reserves held by central banks. That wasn't them dumping the dollar. That was them using the dollar, playing into the strength of the dollar right now. What do you think? The only people promoting the concept of dollar debasement are dogmatists and gold promoters. So that's all I have for today. You can go to our website, download our yearbooks, buy them, subscribe to our Precious Metals Advisory monthly report, look at other free reads and videos that we have there. You can send us information or an email at info@cpmgroup.com asking us to be in contact with you about ways we can help you to better understand precious metals and commodity markets and invest more effectively in these markets. In the meanwhile, take care of yourself, take care of those around you, try to do something good for the world, and we'll talk to you later this week.